We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Financial Partners. This is going to be a really exciting one, Ben. I mean, I've just been laying awake all night.
I was going to say I didn't sleep last night because I didn't sleep Tuesday till now because it's budget week.
Wow. I tell you what, we nearly didn't do this one, but we're going to do it. We're going to do a short one.
What do you mean we didn't do it? There's so much to talk about. Wouldn't it be nice to have this? I think one other budget update we did, we said it was the most underwhelming budget of all time. This could be up there. They might have beaten it. Although we complain when they make too many changes to super, so
That's
maybe
true.
we just can't be pleased. The farmers, there's too much rain, not enough rain. So
That's right.
Business.
Maybe just leaving good enough alone is a good idea. All right,
True.
well, let's rip in. We're going to do this because there actually are some things in there that will impact people. Obviously not everyone, not a lot of massive change, but certainly there are some changes. So let's go. We've got a budget update here we're going to run through. So the first one, we're going to talk about the paid superannuation on paid paternal leave scheme payments. What does that mean, Ben?
It's a mouthful. I think in really simple terms is now when people go on to paid parental leave from the 1st of July 2025, important to note, not this coming financial year, the one after, that super will be paid on those payments. So again, you get, in simple terms, you get the minimum wage for, again, that period of time I think is up to 24 weeks from then as well. It's building up progressively over the coming years. Now, either the mother or father or whatever they would like to refer to them as primary carer is eligible for those payments, and then they're eligible now to get super paid on it. So in simple terms, you used to just get paid, that was it. Now you're getting super paid on it. It's just trying to continue to build that retirement pool for the primary carer who's not in the workforce.
Yep, and historically there's been obviously a reduction in females generally, their superannuation balance due to the fact that they've been out of the workforce, and this is aimed at trying to equalise that because most of the time the primary caregiver is the female.
Yeah, you've probably seen a growing number of that flipping and reversing as well. So it is important to note that either party would get that payment, get that super payment.
Cool. All right, let's go on to the tax changes. So you told me before we hit record that everyone got a little bit of a tax benefit this year. Or actually not this year, but in the coming year. So when is the tax changes effective and what are they?
Effective 1 July this year, 2024, so not far away. Again, there's a little bit of confusion around these, probably depending on which political party has issued the ad, but I think the general premise is that everyone's getting some relief from tax. It's not going to be life-changing, but everything helps. But what happened was there was a scaling back of those tax savings and a bit of a reboot of how they were going to split up the tax bracket. So some people were going to get a larger tax break, and that's been somewhat watered down, but my understanding is that everyone should still get some slight benefit out of it. Again, that was more just saying that they weren't making any further changes to something that they'd made changes to a proposed change from previous, if that makes any sense at all.
So most of the tax breaks are happening in the middle brackets, is that right?
Yeah, so they're just extending some of those out a little bit. So I think your 45,000 to 135,000 earners are probably in the best window.
Yep.
The top bracket goes up a little bit, up to 190 from 180, but otherwise it's not huge amounts. I think we talked about this in a previous podcast, and if you do notice your pay is going to increase from June into that first pay in July, just make use of it. It might be $50, it might be $20, it might be $120 a fortnight, a month, a week, whatever it is. Just make use of that. Reallocate it somewhere. And that sounds boring but that's just what I would suggest.
Pretend that you don't have it and repurpose it. It might be a good time to put it off debt. It might be a good time to add it to some of your other investments if you've got them. If you don't have investments, you probably should. The other one, which I said was the only thing I really paid attention to, was the SAPTO. Well, the reason I'm interested in this is when you think about, so the essentially it's the effective tax-free threshold. So most people, the tax-free threshold, if you do know, is $18,200. That's the amount you can earn before you pay any tax. But there's a couple of other offsets that mean that low-income seniors can effectively earn, and I've got it right here. So a single individuals of age pension age eligible for seniors and pensioner tax offset, their effective tax-free threshold is $35,813. Basically, what does that mean? Why are we interested in that is we start to think about how much money people can actually have invested in their own name, maybe not in super, and still pay no tax on that. So it's not extraordinary, but it will certainly be beneficial for some. There's a bit of tax planning. And
I thought you were excited because you thought you were going to class yourself as a senior.
No, not quite. Peter's going to be happy. He's going to get a little bit of a benefit there. Righto, next one, increasing Medicare levy income, low income threshold. So what's that all about, Ben? Do you know?
And so you've thrown me at that one. It's not the most exciting one. I think basically speaking, again, it probably rolls a little bit off the back of the tax brackets, is that they're just rolling up. And it's probably more just an indexation for inflation thing that those Medicare levies apply to a little bit higher level of income now. So again, 24 and a bit going up to 26.
For singles, yeah.
41 going to nearly 44 for a family. So, and then there's some sort of carve-outs for seniors and single seniors and some sort of, again, niche little bits of it. But again, I don't think anyone's probably going to notice that too much. But again, they've got to note that in there.
Yep. Taxation, small business. So this is probably out of our wheelhouse. We're talking sort of accounting topics here, but extending the 20,000 instant asset write-off. You got anything to say on that, Ben, or not so much?
Not really, because like you said, we're probably jumping into someone else's occupation. But I think that, again, that's been around for a fair period of time. It feels like annually we just note that. I have seen someone recently, and again, this is definitely a conversation for your accountant, is that you could buy an asset and write it off, you get the deduction, but if you then sell that asset, you could be in line to pay some tax on it because you've basically written its value down to zero. So again, I know I'm probably wearing the wrong hat here, but that's if you've done that and written it off, just talk to your accountant. That's really the bottom line, because you can write it off, but you might have some other tax on the other side of it if you're not careful.
Yeah, and we're at tax time now anyway, and you should be talking to your accountant. I know we've got a process in these last few months where we're actually talking to our individual clients and our small business clients about what they could or should be doing to make the most effective use of their tax planning. Do that. If you're not speaking to your accountant, make sure you do it. If you don't have an accountant, talk to us and we'll find you one. Social Security and aged care extending the deeming rate freeze. This has
surprised me. I actually was surprised. I thought genuinely we would be in the deeming rise stage with interest rates running up, and then they've been a little bit lagging with deeming rates.
So maybe just give some context of where it was and why they made the change first of all, because there was a bit of noise around deeming rates there for a while being going back a couple of years ago, not being in line with the reduction in interest rates. So as interest rates went down, deeming rates.
Let's just go one more step back from that. What's a deeming rate? So a deeming rate for anyone involved in, again, Social Security, so aged care, Centrelink, any of those payments. What deeming is it's an assumed earnings rate on any assets you've got that are cash or shares, your term deposits, basically anything from an investment perspective except for property. So all of those assets, they don't care whether you made a loss, a gain, you made 20%, you made zero. They just assume an earnings rate across all of them for simplicity, which makes everyone's job a lot easier. The deeming rate, as you mentioned, was relatively high. As interest rates came down, pressure came on to drop the deeming rate because people were not able to, from a safe perspective, even generate the income that the deeming rates were at.
So it was assuming that they were actually earning more than they actually were.
Yeah, so you're getting penalised, so they're getting less age pension based upon an assumed earnings on their money that they weren't actually earning. If we're in the other area now where deeming rates are lower than probably what most people are generating even from...
So first of all, the deeming rates did come down. They reduced them significantly because of the exact reason. But now we've gone the opposite way. Interest rates have gone up. Deeming rates have been still low, and the suggestion was that deeming rates would start to climb as well.
Yeah, well, I probably thought we would have already raised, to be honest, because we went, a bit like your bank. As the rates come down, they're a little bit slow to do that. But then when rates go up, they're normally pretty quick to tag it back on again. Government's been a bit lagged, and I think giving probably pensioners a little bit of extra relief on this one. So, the main sort of two deeming numbers, and again, there's different thresholds. So the lower rate of 0.25, and then the upper one, which is probably the more important one, is 2.25. So if you sort of simplify that, they're saying that they're assuming a rate of earnings of 2.25% on majority of people's cash or even their super balances and some other areas of investment. So it's pretty friendly still, and they've locked that in. I think we've got another year of that at least now to be in that spot. It's something to be conscious of, and we have conversations all the time with clients about it. But if you're not sure, just ask the question. We can run the numbers and explain it to you.
Cool. Next one, increasing the flexibility for carers to work and study. So the way I read this, and again, I haven't looked at this one in great detail, was that you've got the opportunity to work a little bit more if you're a carer without impacting carer payments. Is that how you read it?
Yeah, I think it's more so from a time input. And again, I haven't really drilled down on this one too aggressively, but in the past, I've had clients where they've been in a pretty significant carer role, but their limitations on them trying to do some work around that meant that they were being sort of assumed that they were, well, you couldn't be a carer if you're working that much. But instead, they were just trying to generate some more money, because being a carer is not a lucrative income from Centrelink. So they were trying to balance too. I think they've acknowledged that you could be a carer for a good chunk of that week, but still work outside of that in a paid capacity as well. So they're just, again, I think it makes sense. It's fair.
Yep.
If people want to, get out and work and care, go your hardest, I'd
Yep.
say.
The next one, increasing job seeker payment. We'll run through these ones pretty quickly, but increasing job seeker payments for people with a partial capacity to work. So I think this was sort of incentivising those people that might have sort of physical or intellectual disabilities or impairments to be able to not be negatively impacted by their work, or if they're able to work for their job seeker payment. So again, if someone's in that situation, hopefully you're getting some support and advice in that regard anyway. Increasing the maximum rate of rent assistance is probably another little attempt to try and affect or impact the cost of living pressures, and particularly with accommodation costs. So there's a slight increase in rent assistance. Anything to say there? Nope.
Nothing too exciting.
Securing cheaper medicine. So again, PBS scheme. Again, I haven't looked at great detail in this one, other than to say that those people that get some concessions on their pharmaceuticals, there's an improvement in that, slight improvement in what you'll have to pay or not have to pay. Is that right?
Yep. Very simple.
Extra funding for aged care. This is one that, again, probably the government did have a Royal Commission into aged care. There's a bunch of those recommendations that still haven't been implemented, and looks like they're going to continue to throw a bunch of money at the aged care system to try and improve home care packages, release a few more home care packages, and also...
It's clearly an area that needs more funding. It probably just needs more people.
Yep.
So I suppose throw the money and hope that people follow, and then everyone will get a better outcome. Again, I think it's probably, you could debate this one till the cows come home. But I think that, again, anything towards that hopefully helps create a better system. With what we are already seeing, and probably everyone around us, is there's a ever-growing demand for home or, aged care facilities.
Yeah.
People going in.
I think it's probably the most topical part, even though it's not a super sexy change. It's just them throwing some money into the pot. But this is something that a lot of people are going to be dealing with, whether they're of our age, Ben. We've got sort of parents that are moving into the aged parents. Sorry, Peter.
Tell Peter you said that. I'm not sure Dad'll be too happy that you said that about him.
But yeah, I think that anyone thinking about sort of aged care and having to deal with the decisions, whether they're moving into aged care themselves or helping decisions with their parents, just come and get support, come and talk to us about it. This one, you said you were excited about.
I was excited for you as a small business owner, the $325 a year rebate off your
electricity bill.
Yeah, I figured that.
And $300 for households.
So we shouldn't laugh at it. Again. I suppose it's like that saying that if there was $300 on the ground beside you, you'd pick it up, wouldn't you?
Yeah.
If it wasn't someone else's. But
I think your point earlier was a good one, is that you can be a bit snide about this, or you can say, well, there's $300. How could that $300, I will be $300 better off. What could I do? I could actually put that $300 against my mortgage, or I could put it into investment for the kids. I could do something with it. Ideally, you don't want to just have that disappear in discretionary spending, which unfortunately is probably what's going to happen to most people who don't have a plan around managing their cash flow. But anyway, it's a small impact, so we'll take it. The last one for anyone got HEX debt or help debts was an interesting one, and the fact that backdated it was also interesting. An interesting creative accounting. Is that the way you saw it?
Maybe it's the skeptic in me.
Yeah.
But just in terms of trusting the system to actually account for that properly when you do a backdated adjustment to people's loans, knowing that, again, anecdotally, and through some clients' experiences, that a lot of people have actually now just gone, I'm just going to whack it on the head, and if they had a balance left that they could afford to pay it, they just cleared it.
Yeah.
Which has then led to the concerns around, okay, well, now I don't even have a debt to get a credit back on. Will I get a refund? I think the guidance, and again, it isn't clear because some people are a bit worried about this. From my understanding, they will get that credit back on their tax return.
If they've paid their debt.
If they've paid out their debt already, it will be backdated. What I would say is just be really aware of that, and probably when you do your tax, speak to your accountant to flag it, so that when you do that return and they check the numbers, is that it looks correct.
Yep. So just to recap on that, if you got a HELP debt or a HEX debt, they don't call it HEX anymore, do they? It's all HELP.
HELP, but everyone calls it HEX.
Okay, cool. So they changed it's the lower of the, is it AWADI or the I'm reading it.
I think it's I think you're looking at the lower of CPI or the WPI, which is a wage price index. So again, there's a couple of random indexes. Basically what they're saying is last year everyone got whacked with a 7.1% indexation to their HEX or HELP or whatever you want to call it.
Due to CPI.
What they've done is they've backdated that down to 3.2. So almost 4% got added on. Almost 4% will get credited back off what your balance was when they indexed it a year ago. Now, moving forward, it will mean that it's going to be around about 4% rather than 4.7. So I think ongoing the difference is likely to be minimal, but it does protect from those events where we'd have a really, a year of CPI going through the roof. And CPI is basically inflation in simple terms.
Okay. Anything else to say about students and debt?
I think talk about it, and I think it's become... I've said this to many clients, is we probably had a decade or more where you just left it and it was at 1, 2, 1.5% indexing, and you let the boss, in your payslip put that little bit through that was mandated, and you were knocking it down progressively. Then probably seeing bigger HEX debts or HELP debts than before. When the indexation hits on 50, 60 grand, like that's a fair chunk of money. Historically, it might have only been indexing on a $15,000, $20,000, $30,000 loan. So I think just have conversations, and probably just what I would suggest to people is don't just go and pay them out. Like, yes, maybe that's your best option. Have a conversation first. I read a few stories where people had 45 grand in the bank and they took 40 of it and paid their HEX debt off because they were worried about indexation. Now you've got 5 grand in the bank, and what emergency cover do you have? Again, maybe it was the best decision. Maybe, again, it depends.
Yeah, I've had a few clients who have asked whether or not they should be paying their kids' HEX debt out. So again, it's about making the most effective use of that. If you do have that capital, like if that money exists and you've got the ability to pay it out, it's like any decision that we make around any client scenario where you've got a debt and you've got some money that you could pay it off. What's the most effective use of it? Maybe it's a combination of. It might be a combination of paying some off and investing some. Maybe, like you said, you got to work out. I think in the next episode,
I think we might roll straight into nearly a clean transition into a conversation.
Well, actually, let me stop this one and we'll start good budget wrap, mate. We'll see you next. We didn't do the state budget. We should come back and do that. Was an exciting one too. We'll do the state budget next week.
Awesome. Can't wait.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britain FP, or Google Burke Britain Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.